Hello and welcome to Morning Markets here on BNN Bloomberg. I'm Matt Scooby. Here are some of the stories that we are tracking for you in the BNN Bloomberg newsroom. Industry Minister Melanie Joly heading to South Korea today to meet with major Asian companies to attract large investments into Canada's defense sectors. The meetings will include talks with one of two bidders on Canada's major procurement project. Joly's also meeting with a Korean business conglomerate and heading to Tokyo afterwards. Her talks will cover the automotive industry, battery manufacturing, shipbuilding, and mining. Well, Scotiabank has received regulatory approvals for a deal to transfer its banking operations in Colombia, Costa Rica, and Panama to Colombian bank Davivienda. The combined operations will create a new hold company known as Davivienda Group. Scotiabank will receive a 20% ownership stake in businesses in Colombia and Central America. And shares of Novo Nordisk are slipping today after the pill version of its weight loss drug Ozempic failed to slow Alzheimer's disease in patients in a pair of large studies. The company says trials to use the drug for Alzheimer's was a long-shot effort as it struggles to regain its footing in the obesity market after losing its top spot to Eli Lilly. Let's have a look at the markets so far today. The TSX having a good day. Start to the day. Again, caution that with what we saw last week with some good starts to the trading day that fell off later. But right now up over 1%, 326 points. Nothing necessarily in particular, at least for now. But again, a good day, broad-based. Once again, we saw this rebound start to try to happen on Friday after that the volatility that we did see in the markets last week. On the U.S. side, also a good start to the day. Again, how about the NASDAQ? Up 2%, 444 points right now. Alphabet leading the way south of the border too in this shortened week. Thanksgiving, American Thanksgiving on Thursday, and then a shortened trading day on Friday too. But looking to watch that rebound with still lots of conversation about the possibility of the AI bubble and whatnot. But so far on this Monday, off to a good start. Well, markets are rallying today despite concerns about that potential AI bubble. However, our next guest says investors have been rotating out of crowded sectors and into less followed areas and has a few investment ideas to share. Joining us now, David Burrows, Chairman, Chief Investment Officer with Barometer Capital Management. Good morning. Welcome.
Good morning. Thanks for having me.
Let's get into this too, shall we, David? You said that market leadership is narrowing, at least in your view too. What does that signal to you about the current level of market risk as a result?
Sure, it's a great question. So we all have this tendency to follow what the index is doing, and that's important. But we know underneath the surface there's good and there's bad. And in general, in a healthy market, over time, more and more companies should participate in a rally. Over the last 3 months, we started to see some narrowing take place, meaning fewer and fewer stocks doing well. But it is interesting because there are some sectors that actually are important for the Canadian market that are less important in the U.S. market that are performing better. And some of the more crowded areas of the market, are having a tougher time. And so it's an interesting time for investors, especially individual investors who can target where they're focusing. And we have been focused more in Canada. We've been focused more internationally. And focused on assets that do a little better in a more inflationary environment. There are some risks that the Fed, is maybe cutting a little too early if they cut again in December.
Yeah, okay, so a little bit to break down there for us, if you can. Let's talk about the Canadian market too, in particular, where you've been focusing, where you may be seeing some of the most rotation when it comes to some of the investor positioning right now.
Well, it's interesting. There is consensus, for instance, that oil prices have to come down in 2026, that we have too much supply. And certainly oil prices have been weak, here in the high 50s. But when you take a look at the XEG, which is the ETF for the major Canadian oil and gas producers, or some of the big leaders, they've been performing remarkably well. Now, in the S&P, energy is like 2% of the index. And it's not always been that way. Early 80s, it was over 20%. But but many years of underperformance. But for the Canadian market, obviously, energy is a lot more important. So companies like Imperial Oil or Tamarack Valley, just marching ahead, despite the fact you see weak energy prices, and that's definitely an out of consensus view.
Yeah, certainly interesting too as we get into it. Now, you touched on the Fed, and let me just let me talk about that before I get into some of the rest of this too. Indications, at least from the New York Federal Reserve and the head of that on Friday, that a rate cut again in December isn't off the table. What's your reaction to that and the impact it could have?
Yeah, it's interesting. I mean, certainly inflation has been coming in ahead of target. I think in the most recent measure, 72% of the components in CPI were above the Fed's target of 2%. So there is risk of a resurgence in inflation. That has been the case historically. You got a first surge of moderation over several months, and then you get a second surge. And I think that the market would tell you there's a risk of that. When you look at more inflationary sectors like financials, and energy and materials and industrials all do better in a more inflationary world, and they've been the leadership. On the other hand, things like the more defensive sectors that tend to act more like bonds have been in general over months underperforming. So I think that there is a real risk there, and I think the market is perceiving that. I mean, look at how strong gold has been.
Mm-hmm. Yeah, and clearly investors finding some at least or they're looking for some certainty in a very uncertain market right now. You just touched on bonds too. Some of those high yields, long-term bond yields, at least for now. How is that contributing to, at least right now, and impacting equity markets, in particular some of those big growth stocks that we have seen?
Yeah, so I think it's kind of a big deal. Last year when the Fed cut rates in September, for the first time in 40 years, long-term rates went higher, not lower. That's bond investors discounting the risk that maybe inflation stays higher for longer and they want to get compensated well. Well, when you pay a very high multiple for a growth stock, you got to take all those future cash flows and discount them back to the present using some discount rate, which is generally based off a long-term interest rate. So it's tough for higher multiple growth stocks when long-term yields stay higher. And that has been an issue. Over the last 5 months, value in general has been outperforming growth. And we'll see whether that continues. But certainly, many of the areas that would be considered value today or less owned sectors are sectors that are a little bit more inflation leaning. And so investors just have to take that into account. And I think realistically, in our view, inflation is the bigger risk to investors than disinflation or falling prices.
Yeah, which is interesting. So on that too, so take me through the portfolio too, where you stand right now, at least for you, cash versus equities, at least for now.
Yeah, so we have a little bit higher cash than we would tend to, and that's just because breadth has been there, and we've over the course of the year come out of sort of 2/3 of our tech exposure. Thankfully, Google continues to be one, but we just see other opportunities. We've been focused on companies that generate a lot of cash. Companies that generate cash and return it to their shareholders by way of dividends and share buybacks. Doesn't really matter what financing costs do if a company generates tons of excess cash. And the second thing that we've been focused on is dividend growth, because when people are facing a rising cost of living, having a rising stream of dividends helps offset that. And that certainly was the case in the 60s and 70s in the last sort of inflationary build-up period. And then the third one is companies that have very, very long backlogs. That mean even if you got an economic slowdown, they've got a really good buildup of future business and predictability over the next few years. And so we're trying to focus on companies with those sort of three key themes.
Okay. David Burrows, Chairman and Chief Investment Officer of Barometer Capital Management. Thanks so much for this, David. Appreciate your time.
Thanks for having me.
Well, up next, BHP Group has walked away from a fresh takeover attempt of Anglo American. We'll have a closer look at the mining intrigue coming up after the break. BHP Group has walked away from a fresh takeover attempt of Anglo American. For more, we are joined by BNN Bloomberg's Lindsay Biscaya. Lindsay, interesting stuff as we get into this too. Kind of take us through what happened with another one with this mining drama.
I know there seems to be a lot of it, and this is all when it comes to copper mining. We've got a lot of companies caught up here. Well, this is actually the second attempt by BHP Group to take over Anglo American. They tried early 2024. Anglo American rejected that deal. And when it was rejected, BHP said it had moved on from the deal and it was going to focus on its own copper production, its own copper pipeline. Yet now we saw BHP try once again to merge with Anglo American, a mix of cash and stock in this deal. And after preliminary discussions, it's reported that the same thing happened again. Anglo American denied the deal and BHP walked away, saying it's going to focus on its own copper efforts. But this is the world's largest mining company we're talking about. When we're talking about BHP, it's an Australian company. And it was seen as a short-lived attempt to also maybe thwart a planned tie-up between Anglo American and Teck Resources, which we're, of course, going to be talking about because that's two other copper mining companies that are all caught up in this.
$60 billion deal. Let's talk about that in a sec. But for now, do we know the reason it's been tight-lipped about, at least at this point, about that second takeover and protect? Do we have any more intel about what happened? Yeah,
we're getting reports at this time in terms of exactly what happened. Those preliminary discussions happened over the weekend. And of course, Anglo American said no. But this shows a lot of pressure when it comes to the copper industry, right? There's a lack of supply right now. And yet we're going to see more demand ramping up in the future, particularly when we're talking about the world of AI, right? A lot of data centers need copper for so many different things. When we're talking about wiring, cabling, electric cars as well need a lot of copper. So BHP largely focused on Anglo's copper division. Particularly, there's three big mines that Anglo American owns. They're in Chile and Peru, and it seems as though BHP was quite focused on that. The takeover would have resulted in a dominant copper producer when it comes to BHP. And when a couple different countries heard about this potential takeover last year, China, Europe also not happy about that because BHP would have had to deal with some regulatory issues as well. But now it's not going to have to because Anglo American said no.
So let's just quickly touch to Canada's Teck Resources and Anglo. They've been, again, they've been working about this merger. Shareholders expected to vote on that $60 billion merger in the next few weeks, right?
Yes, that vote date is December 9th. So yeah, as you mentioned, $60 billion merger, that's what we would see here. Most shareholders, they are expected to vote yes. But because Teck is a Canadian company based out of Vancouver, the federal government would need to approve it. There's signs right now, Industry Minister Melanie Joly is actually not quite happy with it. She says some of the pledges that Anglo is making are insufficient. But we'll have to wait and see what shareholders decide as well on December 9th and whether maybe Anglo American kind of sway the federal government and keep jobs in Canada is one of the big things that the federal government would like to see. Anglo and Teck estimate they can save $1.4 billion US annually by merging. And the two largest mines that they both own are in Chile. They're about 15 kilometers away from each other. So it would be pretty convenient if the two companies merged. I believe that's what probably a lot of CEOs on both sides are thinking at this point, and merge those two mines together. But again, that vote happening December 9th.
Okay, we will see lots more drama. BNN Bloomberg's Lindsay Biscaya for us. Thanks, Lindsay.
Thanks.
Well, coming up, outlook for U.S. markets amid a possible Fed rate cut and easing AI worries. We're going to have more on that coming up next. U.S. markets opened in positive territory this morning. There are signs the Fed has room to cut rates further, and fears of an AI bubble appear to have taken a back seat. Now, we got more from Brad Bernstein, Managing Director at UBS Private Wealth Management.
We maintain the view that the bull market is absolutely still intact. We see 7,300 by June and potentially 7,700 by the end of the year, driven by three things. One, yes, more Fed rate cuts. Two, continued strong earnings and the AI growth story.
Let's start with the Fed rate cuts. It's gone back up, I think, about 70%, the odds right now for a cut coming up over the next little while. How many do you see, and how many would you like to see?
So we see right now 2 by the end of the first quarter. So there's 3 Fed meetings coming up between now and March 31st. We see at least 2. I think the volatility that we saw, that incredible reversal on Thursday, when markets had a great morning, and then around 10:30, we saw them just fall apart and have a real ugly close on Thursday, was probably caused by the U.S. government's announcement that the November job data would be delayed about a week post the December 10th Fed meeting. And then we walked in Friday morning, 8 a.m., and we saw the Fed, John Williams, vice chair, very influential, put out very dovish comments. That turned markets around on Friday. And we went from about a 30-ish% chance of a cut Thursday morning to today. It's actually about 77%.
And so a reason for optimism. And what happens, though, if we only get, say, one cut? What kind of a play is that?
I think markets, what we've seen over the last few weeks, the volatility that we've seen has really been caused by the uncertainty post the last Fed meeting with the hawkish cut that we got. So I think for markets to have a smooth ride, we need to have more continued, understanding of Fed policy and rate cuts. I don't think, clearly if we don't get a rate cut on December 10th, I do think that would be a cause for some more volatility that like we've seen recently.
All right, and of course, the other big thing that's driving everything right now, AI, NVIDIA, we saw their earnings last week. They were good. They were better than expected. We still saw a negative reaction to it. Today, though, we're hearing that they may be able to start moving more chips to China. How important is that just for NVIDIA and for the AI itself?
Well, I think there's no doubt that what we're seeing is major increase in CapEx spending in AI next year. But what's more exciting for us is the clear evidence of monetization happening. Look no further than enterprise software, computer-facing applications that are generating revenue, as well as many leading cloud platforms have reported increasing revenue. So it's not just about the spend. We're really, we think the critical next phase of AI growth is the actual cash flow positive story that's starting to happen.
And how important is that you're seeing it across the group, not just NVIDIA, not just in one company?
Well, I think it's critical. I think it's critical for the rally to continue. It's important. Part of the volatility perhaps has also been the concerns around the continued growth and not just the spending, but the actual profitability and cash flow generation, as I just mentioned. So I think it's critical for the rally to continue, that next phase does develop and continue to develop.
And is there room for all of them to succeed here, do you think?
Well, I think it's impossible for every company, in the AI space or in any space to be incredibly successful. There will certainly be winners and losers, but the overall story remains strong. The spending is undoubtedly increasing, as well as I just mentioned, the positive cash flow and actual profits and monetization starting to happen.
And what about the rest of the market to you? I mean, there's so much talk about AI, but what about the rest of the market, and what is it doing, and what opportunities do you see there?
So one of the positive stories that we just saw as we come to an end here in quarterly earnings season for the third quarter is that it's not just big tech that's having the growth. The median earnings growth rate in the S&P was over 5%, which is higher than normal. We saw earnings this year up about 11%, and now we're projecting overall earnings to be up about 10% next year. So earnings growth is across the board now, which is extremely encouraging going into the next year.
And just taking a bigger picture going overseas, you were looking at Japan, and that's caught your attention.
Yeah, well, we actually also just increased our estimates on Europe for next year. We just upgraded Europe to attractive. One of the big catalysts in Europe is Germany, who will be spending about 20% of their GDP on infrastructure and defense spending. So that's actually a big catalyst in Europe, and we think Europe looks really good going into 26. It had a great 25, but we think it'll continue next year. And
Japan as well, the spending plan there, your thoughts on that?
Yeah, absolutely. And I think what they're doing right now with their Fed policy also has a big impact on global markets right now. So Japan's very important, and we do like Japanese markets.
And how do you see, what kind of an impact do you see that having on the world markets?
Well, I think I think what markets like to look at is the yen to the dollar, right? And what they're doing with interest rates. And it has a huge impact on risk taking. There used to be the yen carry trade that's always had some, material impact on global markets. But outside of international, internally in the US, we also like financials, healthcare, and utilities as well in the US.
That's Brad Bernstein, Managing Director at UBS Private Wealth Management. Well, for more on what's driving trading today, we are joined now by Bloomberg equities reporter Monique Molima. Monique, let's start, if we can, with Barrick Mining getting an upgrade today, too.
Hi, yes, good morning. So Barrick Mining, they got an upgrade at Bank of America today. The analysts there said that they see the stocks as more fairly valued now after there's been some recent declines. They also see opportunities from the Nevada Gold Mine project, the 4 Mile project as well. And they really see that this company is going to be able to kind of restart some of that growth. Barrick is also rising this morning after the company announced that they have reached a resolution in Mali. That's been something that's really been weighing on shares for the company of some of the ongoing disputes there. And Barrick said that they're also going to be able to regain control of the mines there as well.
Okay, so some significant news, too, that they did settle, that they did finally come to a resolution for the mine. On the other hand, and going the other way, Canadian Natural Resources, which is interesting, too, getting downgraded today. Take us through the reasoning for that.
Yes, so Canadian Natural Resources, they were downgraded at Desjardins this morning. The analyst there said that there's been some concerns with the company's performance after it's announced the acquisition of the Athabasca oil projects and the Duvernay assets that it had acquired from Chevron Canada. And there was just some concerns about the leverage that the company had to take on in order to acquire these assets. They see that there's still strategic importance and that this is going to help the business long term. But for right now, it's really weighing that the company is going to have higher debt coming to it soon. And also oil prices are expected to be softer going through next year. So that's something that's also weighing on the company as well.
Okay, certainly interesting too. It was named a top pick by RBC too in the energy sector last week. So we'll see. The other interesting one for you too that I was looking at was Oklo, which is again smaller company, design and development of advanced nuclear microreactors. They've had a fantastic year, but they also got some more positive news.
Yeah, so Oklo, like you mentioned, they've been really outperforming this year as there's been a lot of investor interest around the nuclear space, as there's been more demand for power for things like data centers. And today, Citi did a big price target rise for Oklo, seeing more opportunities ahead. Oklo is diversifying its business. It is going to be doing radioisotopes. And Citi says this is going to really provide some new financial opportunities for the company. This segment is expected to see about 20% unlevered returns and also starting to be in operation by mid-2026, which is a lot sooner than some of Oklo's small modular reactors that might not be in operation until 2027 or 2028. So they really see new opportunities to kind of bring in some revenue from this in the meantime and see this helping the share prices as well.
And again, so it's an update on the timeline too, and for them, their investors are hoping to watch that growth continue even into the next year?
Yes, so the Oklo announced earlier that they are going to be kind of pursuing a new strategy in terms of Department of Energy in the U.S., their authorizations there, which are expected to help speed up kind of all of their projects. So on the small modular reactor side, as well as with this segment too. So that's something that's really been in focus for investors because this is a company that largely doesn't really have profits at this point. This is something that they're looking to expand in the small modular reactor play segment, but this is still really new industry, new technologies. So being able to get those approvals quicker, to move faster in terms of actually having these projects up and running is going to be really beneficial to the company. And that's also why we've seen their share prices increase recently.
Okay. Bloomberg's Monique Molima, thank you so much for this. Appreciate it.
Thank you.
Well, coming up, now that earnings season is almost over, where will investors look for direction as we head towards the end of the year? We'll get some ideas coming up after this. Barrick Mining says it has resolved its disputes with the government of Mali over 2 gold mines in the country. Barrick says charges made by the government have been dropped, and steps are being taken to release 4 Barrick employees that were detained. Operational control over the 2 gold mines will be handed back to Barrick from the government. Canadian factory sales fell a little over 1% in October, marking a partial reversal after a rise of over 3% in the month of September. The largest decreases in October were in the chemical and forest product sectors. Manufacturing shipments also down 1%, reflecting pressure factory owners are facing due to uncertainty in the trade war with the U.S. The data is early estimates by StatsCan and may later be revised. And Prime Minister Mark Carney says the world can move on from the U.S. after its boycott of the G20 summit held in South Africa. Carney says the summit brought together 2/3 of global GDP and that the center of gravity in the global economy is shifting. U.S. President Donald Trump boycotted the summit, saying white farmers in South Africa are facing a genocide. Let's have a look at the market so far today, too. Again, things are off to a good start this week, especially for the TSX up right now, 352 points, up over 1% here to start this day on Monday so far, continuing that strong rebound that we did see on Friday, at least to start this shortened week in the U.S. Let's have a look south of the border, too, where all U.S. markets are also up to start the day. S&P slightly above, again, still over 1%. How about a day for the NASDAQ, too? Close up to 500 points, over 2%. Alphabet leading the charge on the day today, but certainly investors are not spooked after last week's volatility. Well, last week was all about earnings from NVIDIA and concerns over the AI trade. But now that earnings season is winding down, investors will have to look at other sources of data for direction. We've got some ideas from Kyle Taylor, wealth advisor and portfolio manager at TriDelta Private Wealth.
Sentiment is shifting and volatility, I think we can expect to continue. To the many AI investors out there, though, I would say that any long-term investment theme that you think is here to stay, it will have periods of good times and periods of bad times, disappointments, and I think you can either look at those opportunistically or you can look at them as a time to panic and buy into something else that you understand. Really, towards the end of the year, I think you mentioned it, there will be a bit more of a focus on some of that lingering U.S. economic data. Tuesday and Wednesday of this week, we'll see some reports that give a little bit more light into how the consumer is doing. But in terms of where I think that there are some things to be aware of and opportunity is, on something that's been well covered has been the level of concentration, particularly in the U.S. But I know we have some of the same issues just with different sectors here in Canada. Mm-hmm. But the U.S. healthcare has been something that your last guest talked about. It's something that I've actually talked on the show about quite a bit this year, and it finally seems like we're seeing signs of life there. I bring that up because there are entire cohorts of the market that are maybe less appreciated. It's still pretty reasonably valued, carry pretty good yields, and healthcare in the U.S. is something that we've certainly seen a lot of prospect in.
I was like, it's not really having a bad year, is it?
Well, not anymore. The last 2 months has been one of the best performing sectors in the U.S. Notably, actually, just last week, it was Eli Lilly became only the second ever non-tech name to reach a $1 trillion valuation. And they did that with some of the stories around obesity and the diabetes drugs that are out there and that they're capitalizing on. But yeah, over just the past 2 months, they're up 14%, but still the sector as a whole, I believe, is up about 11% year to date.
So is there still some deals to be had, do you feel?
I do, yeah. Particularly, I think if you're an income investor, I mean, you have Bristol Myers that's still trading at an over 5% yield and in a single-digit price earnings. We own Pfizer, Johnson & Johnson, Bristol Myers again, Eli Lilly, United Health. I still think that there is room in that space, and some catch-up and some really just appreciation of the fact that the headlines earlier in the year around bringing U.S. drug prices down, some of the headlines from the U.S. administration weren't as negative as we maybe originally thought just a few months ago.
And I just want to go back for a second to the data coming up. How is it important, the data that we're going to see this week? Could it have a real swing on the market, real impact on the markets? And also thoughts on what we're going to see for a Fed rate cut. Will we see one? And same with up here.
Well, I think all year there's been a big divergence between how investors are feeling about the world and how consumers are feeling. Particularly in the U.S., there's a University of Michigan consumer sentiment survey that I follow pretty closely, and they're actually reporting consumer sentiment worse than it was in the depths of 08-09, which is pretty shocking. I know that the stock market is a forward-looking beast, but I think we have to appreciate what the consumer is actually seeing. Higher income cohorts they've continued their spending at large, but some of the lower income segments, I think that's where a lot of people are taking their cues from some of the retailers like Walmart, Dollar General, Dollarama, which have had really great years. And I think that sort of speaks to some of the reason why, as people look away from maybe some of the brand name products that are out there. In terms of interest rates, I think I wouldn't be surprised. I do think it could go either way in December. And if it does go where they opt to hold things steady, I think they cite the lack of data availability from the U.S. government shutdown. But I do think we'll see at least one before the end of the first quarter.
All right. And I'm dancing a little bit, but getting back to the investing, what to look for. You feel one of the kind of the worst things you can do is just simply buy the index.
I do. I mean, I think there's a time where being a passive investor is okay, but I think we're in an environment today where if you're not being active, you're certainly could be jeopardizing your portfolio on the downside. I mean, if you are an index investor and that index falls 20% and your portfolio falls 20%, it's not a one-to-one. You need to rise 20% to get back to where you were. Just the way the math works out, you need to rise 25% just to get back to where you were prior to that correction. If you experience only half, if your portfolio goes half of what the index does, goes down 10%, you only need to get back 11% just to be back to where you were. That's just the way the math ends up working. And I also think that there's a lot of opportunities out there on the international side that maybe go apart from some of the U.S. names and U.S. concentration. I think a lot of people today, even if you're buying a global equity fund because you want some more international exposure, well, most global equity funds have between a 50 to 60% weighting in U.S. names. I think you have to go more international, excluding North America. And there's a lot of reason to do so. I think particularly in Europe, one of the things that's driven the U.S. rally of the previous years coming out of COVID has been a continued emphasis on fiscal spending. Everybody spent during COVID, but post-COVID, the U.S. really stood apart in terms of their spending to continue to prop up the economy. A lot of other nations didn't follow that and focused much more on bringing those deficits down. Europe is finally, and it's been evident this year, is there's been a notable shift towards spending. Germany is a very good example. I mean, with just their plans to increase on infrastructure spending, that's a doubling of what they're currently spending, and there's a lot of opportunity there for a lot of those names.
Okay, I just want to get to one more question because we want to get to some of your stock picks and staying European. NLS.PA.A. Was that how you pronounce it?
Yeah, that's an Italian utility. I know being Canadian, we know our utility companies quite well. Goes back to the electrification around some of the data centers and actually some of the AI trade even. If you just look at the expected power needs of the data centers that are being planned in Europe over the next 10 years, that already is almost the equivalent of current power demand in all of Europe. So a company like Enel, it's trading at only about a 13 times earnings. That's in comparison to in the US and Canada, which are sort of in that low 20 price earnings range. They have a good prospect for continued steady growth. They have operations internationally, but I think European-wise, they have quite a few catalysts for continued growth. And in the meantime, you're getting just over a 5% yield.
It's Kyle Taylor, wealth advisor and portfolio manager at TriDelta Private Wealth. Well, coming up, Morningstar's predictions for the markets in 2026. Stay tuned. Well, no one can predict what 2026 will bring, but there are some themes that have emerged on a consistent basis this year, such as tariff tensions and high valuations in the AI sector, making investors nervous. Now, Morningstar has prepared a report with an outlook for 2026. For more, we spoke with one of the authors, Philip Strail, Chief Investment Officer covering the Americas for Morningstar Investment Management.
one of the things that is still an uncertainty at this point is the potential decision by the Supreme Court in the United States, potentially in December or January, with an announcement around their decision as to whether some parts of the tariff framework, whether that will be shut down. I think that will create some volatility. So as we look into 2026, we don't expect the April level, volatility, but certainly still uncertainty around there with the tariffs in 2026.
What kind of a twist would a ruling have that some of those tariffs were unenforceable? They'd have to pay money back. That could make for a bit of a nightmare for businesses.
Yeah, I would say actually the biggest trading partners, our expectation would be that those tariffs will just be shifted in terms of the legal statute. So there's probably not a huge impact. Some of the smaller trading partners, it might actually be a relief, but it will just create uncertainty in the market where markets will be wondering which sectors might be impacted. But by and large, we would not expect the same type of downside risk as we've seen in April of 2025.
And geopolitically, I mean, we're hearing possible talk of a peace deal between Russia and Ukraine. No guarantees, of course, with everything the way it's unfolded there. But I mean, there is talk of that. What kind of an impact would something like that? Are there any other geopolitical aspects that you're keeping an eye on?
Yeah, the Ukraine-Russia deal obviously would be significant in terms of the impact from a humanitarian standpoint. We'd say energy prices, oil markets would likely be most impacted by that. We've seen some downward pressure on oil, as you've pointed out this morning. And so it's mainly on the energy side, we would think, as far as, kind of the market implications, but obviously a very important deal as well. The second element will be defense companies, which have done very well this year, especially in Europe. And so a potential deal there would put potential downside pressure on defense stocks if that were to come to fruition.
And of course, the thing that everybody's talking about, AI, what's next for it? We had some pretty good earnings for the most part, still some nervous investors out there. Is that going to change, do you think?
AI has been the dominant theme for the past 2.5 years, really off of the low in April. That really was what reassured markets, and a lot of these AI stocks, NVIDIA, did very well off that low in April. But we think that there's probably been a level of frothiness and very elevated expectations that have been baked into some of those valuations, and we've seen a bit of a pullback in these stocks in recent weeks on the back of even beating earnings. And so at this point, it's probably more of a sentiment shift. But going into 2026, big question is whether those companies will stick to the CapEx plans that they've announced so far this year.
And they've been aggressive with that. Is that what's making most investors nervous then?
I think it's part of it. I think there's a technical element, as I mentioned, where I think the market's gotten somewhat narrow, especially in the September-October period. And in recent weeks, we've seen a bit of an unwind there. But if we were to see a pullback on the CapEx guidance by the large hyperscalers, I think that could lead to more significant downside. So our view would be for investors to try to diversify away from some of those large cap names and find opportunities perhaps in higher quality healthcare and consumer businesses, for example.
And yeah, healthcare's it's had a nice bounce back lately, and you still think there's some deals to be had, though?
We think so. Yeah, we think it's underperformed the S&P 500 for the third consecutive calendar year. It's kind of lagged the S&P by about 70% over that time frame, and so we still think that there's value. It's has better earnings growth than the overall market, and we still think that there's room for some of that regulatory overhang to ultimately boost some of those stocks.
And outside North America, what are some of the things you're looking at?
We still like non-U.S. stocks from our perspective, especially if you are, from a Canadian or from a U.S. investor standpoint, given valuations, also from a currency perspective. We like Latin America as one of the areas. For example, in emerging markets, it's trading at Brazil, for example, is trading at 11 times earnings, and that's much more attractive than, let's say, the S&P 500 that's closer to 23 times earnings.
And also, you mentioned in some of your notes here, talking about the UK as well is an interest to you.
Yeah, the UK is, despite its, kind of economy that is, there's obviously different things going on with the budget there, but access to a lot of high-quality global businesses. And if you look at that market from a valuation standpoint, we can still see a lot of value in those businesses. And so, given the strong rally we've seen in many parts of equity markets, we think the UK is an attractive area to be as well.
And just one, we're almost out of time, but just quickly about South Africa as well. You're calling it a hidden gem.
Yeah, South Africa is one of the markets that we like, and we think from a commodity cycle standpoint, and given some of the pressures we've seen on the commodity side of things, that's an area that we like. It's an early story, and we might see some volatility there, especially if we talked about the geopolitical dimension, but it is one of the areas that we like as well within the emerging markets.
That's Philip Strail, Chief Investment Officer covering the Americas for Morningstar Investment Management. Well, up next, Canada's relationship with India appears to be warming up as Prime Minister Mark Carney and Indian Prime Minister Narendra Modi meet face-to-face in a G20 bilateral meeting. We're going to have more details on that coming up next. It was 2 years ago that trade talks broke down between Canada and India after allegations Indian government agents were involved in the assassination of a Canadian Sikh leader. But this weekend at the G20, Prime Minister Mark Carney and Indian Prime Minister Narendra Modi agreed to renew trade negotiations. For more, we were joined earlier by CTV's Colton Prail.
You can group exports from Canada into two categories, to the U.S. and to everybody else. And in that second category, it's about 25% of our exports, Mark Carney has promised to double non-American exports. And getting into countries like India, like China, is going to be crucial to doing that. India is the fourth largest economy in the world, projected to be third by 2028, but they are only our 10th largest trading partner. We're talking about $5 billion in exports to them last year, $30 billion in total trade. I mean, that is a drop in the bucket compared to the $600 billion to the U.S. or even just the $30 billion exports to China. There is room for growth here, and creating the framework for those negotiations, ensuring that there's a dispute mechanism process, all of those things go towards improving trading relations with the country. We saw not only the bilateral meeting with Narendra Modi, not only the commitment to formally restart talks towards an economic partnership, but the agreement of a trilateral agreement, trilateral initiative, I should say, with India and Australia when it comes to tech and innovation. There is very much a concerted effort, not just on the goods side, but on the services side as well, to improve relations with India and to be more involved in that not only corner of the world, but in those economies. This is something where Canada has said they want to double total trade with India by 2030, up to $70 billion. And so this is very significant. We also saw the Prime Minister commit to a trip to India early next year. That's likely going to be the AI summit in February, but that part yet to be confirmed, although we know that he was responding to an invitation that Narendra Modi gave for that summit. And so, that this really is a move forward, but it's also important to keep the political context in mind, because as much as this is about economies and trade, there is a reason talks broke down, as you point out, in 2023. We know that transnational repression and foreign interference are two very significant concerns, and that India is a very heavy state actor when it comes to that involvement on Canadian soil. We know it's been an issue, and so the balancing act between those two priorities is going to be difficult, something that was put to the Prime Minister and the Public Safety Minister over the course of the weekend. Carney said that it's possible to have those economic deals with countries that you don't necessarily agree with entirely. He called it friction, and said you could gauge the level of interaction between the two countries by the depth of trade between the two countries. The Public Safety Minister pointed to an upcoming foreign agent registry as one way that the country would be trying to ensure that public safety was top of mind throughout all of this. It's important to point out, though, that foreign agent registry, has been long promised by this government, and they say it's still several weeks out before we see a commissioner and that agency actually created, and that's something that Canada has been very much a laggard on. And so this isn't going to go away. There will continue to be discussions about that balance, but certainly the Prime Minister has said that this is going to be something they're focused on.
That was Colton Prale from CTV News. Well, Market Call is coming up next. Today on the show, we have Paul Harris, partner and portfolio manager at Harris Douglas Asset Management. His focus will be on North American and global stocks. Let's have another look at how the markets are faring on Bay Street and Wall Street so far today. Again, so far, so good. There's been lots of volatility here in the last week or so, where you're not even just day to day, but hour to hour, where things have, again, swung in many different directions. But so far, the TSX still in good shape here as we get to the top of the hour, up over a percentage point, 353 points so far. Pretty broad-based for now. Shopify having a good day, at least in the last little bit. Also some mining stocks that have seen some gains today. Wall Street, things also, again, trending positive so far to start the day. Saw some minimal gains initially, and now the NASDAQ up over 2.3%. The S&P 500 also having a good day too, up over 1.3%. We did mention too, at least for now, Alphabet has been part of those gains too, and a lot of this good news being driven by the Fed rate. That we got some news on Friday that the U.S. Fed, there's the possibility of them cutting rates again. It looks like possibly in December. Now it looks like traders banking on that up to 80% probability right now. So again, watch for that to continue over the course of the afternoon. Market Call is coming up next. Thanks for being here.